Hi everybody, I'm Daniel Patron with S3 Realty, and today we've brought in a mortgage loan officer to kind of shed some light on and demystify the lending process. So why don't you go ahead and tell everybody, why don't you go ahead and introduce yourself to everybody and tell them who you are and what you do.
Awesome, thanks so much for having me.
Sure thing.
My name's Mary Greenwood. I've been with Ent Credit Union for almost 11 years. I've been originating mortgage loans there for over 5 years. I love what I do. It's so much fun to see a first-time home buyer at the closing table with a brand new set of house keys in their hand.
Absolutely, it's the best part of the job.
You bet.
So let's start off talking about PreQual and PreApproval. I get so many people who call me because they found a house on the internet that they love, but they haven't talked to a lender yet, and so they want to go look at homes, but they haven't secured their financing. So as realtors, we're constantly encouraging our buyers to go out there and secure their financing, because when we do find that house, we want to be able to act quickly, and we can't do that if we haven't secured our financing. So tell people a little bit about PreQual versus PreApproval.
You bet. A pre-qualification is when I sit down with a buyer and I take a look at their debt-to-income ratio. A debt-to-income ratio basically just tells me how much of their gross monthly income is going out in debt, including a proposed mortgage payment. So at that point in time, I would know what their maximum loan amount is going to be with a pre-qual.
Gotcha. And just to confirm, this is all done verbally. They're not submitting paperwork at this point.
You bet. No paperwork. We can do it over the phone. It's a really quick calculation.
Cool. So now take it the next step and tell us about the pre-approval.
A pre-approval is when the buyer and I will sit down, we'll do a loan application, I pull their credit, I get their employment and their income information, I'm going to take a look at their pay stubs, their W-2s, any other documentation that I know that the underwriter is going to need to verify. The underwriter is going to be really my verifier to make sure that I'm doing my calculations correctly, that all of the income is going to be viable. In about 24 hours, we've completed our pre-approval process, and I can get you your pre-approval letter.
Cool. And just so everybody knows out there, that pre-approval letter, all of your information, all your paperwork has gone to underwriting for that initial review. And when we get that pre-approval, it's a very strong instrument to go out there and purchase homes off. It's much stronger than a pre-qualification. And if I was selling a piece of property and I got two offers that were very similar, and one had a pre-qual and one had a pre-approved, I'm gonna talk to my seller, and we're probably gonna go with that pre-approval. So it's just a very strong instrument to have when we're out there purchasing homes. So I think we've covered the difference between a pre-approval, the pre-qualification. We determined that a pre-qualification is way stronger and that it's important to get that. We've covered the documentation that you're going to need to secure that pre-approval. Just one thing on the underwriting, that is, if the underwriter comes back and asks for some additional documentation from Mary, she's going to ask that from the buyer, and just do your best to get that information to them as fast as possible so they can get you that pre-approval letter. So moving on now, let's talk about some of the loan packages or some of the options that Ent has for buyers.
You bet. We offer a VA loan, which is insured by the Veterans Administration. You do have to have a little bit of military time to qualify for a VA loan, but VA loans are great because you don't have to have a down payment.
Correct.
And there's no mortgage insurance on those. That keeps your monthly payment really low.
Right. Which I told you, we're going to cover mortgage insurance in just a little bit. So what's next? We have a VA. How about FHA?
FHA is insured by the Federal Housing Administration. They're a part of the government that will insure higher risk loans for us. So let's say that you're just starting out with your credit. Maybe your credit score is in the mid-600s, which is fine, but it's a better candidate for an FHA loan. Let's say that maybe you have a higher debt-to-income ratio, or if you're using a down payment assistance program.
Cool. So talk about that. Talk about the down payment assistance program.
You bet. There's an El Paso County turnkey loan that will grant you a certain percentage of your loan amount as your down payment.
Wow.
So let's say that maybe you're a little bit short with your down payment, but there's this house that you really, really love and want to get into. You could qualify for that grant program using the FHA loan. You will see a slightly higher interest rate and closing costs on those, but that's the joy of getting a grant.
Cool. So we covered VA, FHA, turnkey, or the down payment assistance program. So why don't you tell people about the conventional products?
You bet. Conventional loan is really the best case scenario. If you're a first-time home buyer and you have at least 3% of your purchase price to put down, you would be able to qualify for our first-time home buyer loan. That is a 30-year fixed-rate loan, but Ent will actually waive our origination fee and our processing fee.
Cool, and that's a savings of?
Well, it all depends on your purchase price.
Okay.
You bet. So if you have your own down payment, Ent is going to help you out with the closing costs a little bit to make that a little bit more manageable for you or for your seller.
Cool. So I think we've covered everything we came here to cover. Let's cover mortgage insurance kind of quickly. We said that the VA doesn't have it, but the FHA products do. What about the conventional? Tell us a little bit of what mortgage insurance is and
You bet.
all along those lines.
On the FHA loans, you do have to pay mortgage insurance for the life of the loan. With conventional, you have to pay mortgage insurance until you have 20% equity. Now, what is mortgage insurance? It's really nothing that protects the buyer or the borrower. It actually only protects the lender in case you default on your loan. So getting rid of the mortgage insurance quickly is going to be in your best interest if you want the lowest monthly payment.
All right, cool. I think we've covered everything we came here to cover. Mary, thanks very much for coming out and kind of demystifying and shedding some light on the lending process.
Absolutely. It's my pleasure. Thanks for having me.
Absolutely. That was pretty good.
Yeah.
I can work with that.
Okay. Cool.